Okay, so let's dive in. There's this single metric, right? Interest rates sounds dry maybe, but it's quietly, pulling the strings of the whole global economy. Affects everything.
It really does. It's like this invisible hand, as you say.
Yeah.
And the source material we're drawing on for this deep dive, it comes from a Swiss economist, someone with real deep global investment experience through lots of different cycles.
Hmm.
And they make a really strong case that, well, understanding these rates is just absolutely critical today.
Right. And the goal here isn't to get lost in the weeds, with technical jargon. It's more like giving you, our listener, a shortcut, a way to get genuinely well-informed on how these things actually work.
Exactly, their global reach, which is maybe surprising.
Yeah, and crucially, how you can strategically adapt, all pulled directly from the insights in this material, specifically for you.
Think of it as cutting through the noise, getting to the heart of the dynamics driven by this one core mechanism.
Okay, so let's pull back that curtain then at the most basic level. What is an interest rate?
Well, fundamentally, it's just the price of borrowing money. Simple as that, really.
But it's more than just a price.
Oh, definitely. The power comes because the key rates, the benchmark ones, are set by central banks. The Fed in the US, the ECB in Europe, the Bank of Japan.
And they use this rate like a tool.
Exactly, like a steering wheel for the entire economy.
Steering between,
Now,
putting the brakes on inflation if it's getting too hot.
yeah, cooling things down or hitting the gas if growth is stalling and they want to stimulate things.
Okay.
And this policy rate they announce, that's the anchor. It's not necessarily the rate you get on a loan directly.
Right. My mortgage isn't set by the Fed?
No, but it's fundamentally influenced by it. That policy rate ripples out and affects mortgages, car loans, business borrowing, government bonds, pretty much everything.
So they're not just passive observers reporting numbers. They're actively trying to shape the economy with these decisions.
Absolutely. They're incredibly powerful levers. They change the cost of capital for every single business. They influence whether you feel like saving your money or spending it. They send signals to investors about risk appetite. And they directly impact currency values. They're not just numbers on a screen. They're potent economic signals.
Okay, this is where my head starts to spin a little. How does one decision, say, by the Fed in Washington, D.C., manage to ripple out and affect the whole world? That seems huge.
It is huge, and it's central to what the source calls the global transmission mechanism. In today's world, everything's interconnected. Capital money, it flows globally, constantly seeking the best return, and it adjusts almost instantly to shifts.
So if the Fed bumps up rates, U.S. dollars or U.S. bonds suddenly look, shinier, more attractive than other options?
Pretty much, yeah. Capital naturally flows towards higher perceived returns or sometimes just greater safety. And this kicks off effects through several channels all at once. It's what the source calls a financial butterfly effect.
A butterfly effect. Okay, so a small flap here causes a storm elsewhere.
That's the idea. A rate hike in Washington can genuinely cause, unexpected financial weather far away.
Like what? Can you give some concrete examples from the source?
Sure. First, exchange rates. Big one. If U.S. rates climb significantly higher than, say, European rates, investors worldwide want dollar assets. To buy them, they need dollars.
Demand goes up.
Exactly. Demand pushes the dollar's value up, strengthens it, which sounds good, maybe, but it makes U.S. exports more expensive for others to buy while making imports cheaper for Americans. It's a trade-off.
And how does that actually hit specific places?
Well, the source talks about how a Fed hike could trigger big currency swings, maybe somewhere like Istanbul, if Turkish companies borrowed in dollars.
Ouch.
Yeah, suddenly that debt becomes much harder to repay in their local currency. Or it could spark asset sell-offs in a market like São Paulo, as global investors pull money out to chase those higher yields in the U.S.
Could it also cause booms somewhere else? Seems counterintuitive.
It can, potentially. If global capital is looking for safety or just different kinds of returns, it might flow into, say, prime real estate in perceived safe havens like Dubai or Zurich. Even if local rates there aren't changing much, this influx of foreign money can fuel local asset prices.
Wow. Okay, so it's not just currencies. It's asset prices, too.
Critically important. Think back over the last decade or so. Globally low interest rates made owning assets, stocks, bonds, real estate, incredibly appealing.
Because the alternative, like safe government bonds, paid almost nothing.
Precisely. You were almost forced to take more risk to get any kind of return. Plus, low borrowing costs made companies' future earnings look much better when discounted back to today's value. All that inflated asset prices.
And when rates go up?
The whole picture flips. Suddenly, safe assets look better, borrowing gets more expensive for companies, for individuals buying houses, the math changes. And that pressure can lead to big shifts, realignments in asset prices, sometimes quite sharp corrections.
Right. And then there's debt dynamics. If you have variable rate debt,
That's a huge vulnerability. Businesses or even countries that borrowed heavily when money was cheap, near zero rates. Sudden sharp rate hikes mean their debt payments can skyrocket almost overnight.
crippling.
It can be. And that's a major part of the spillovers the source highlights, especially for emerging markets or nations already heavily in debt, particularly if they borrowed in dollars or euros.
So they get a double whammy. Their currency weakens and their borrowing costs shoot up.
Exactly. It's a tough spot.
It really sounds like these central bankers are walking a very, very fine line, a tightrope.
It's an incredibly delicate balancing act. That's a key theme in the source. Their main mandates are usually price stability, controlling inflation, and maximizing employment.
But push rates too high.
You risk choking off economic growth, maybe even causing a recession, keep rates too low for too long.
You risk runaway inflation, asset bubbles, like we've seen.
Precisely. We've definitely lived through that tension very dramatically recently. The long stretch of super low rates after the 2008 crisis, and again during the pandemic, it did help recovery, sure. But it also, arguably, sowed the seeds for the inflation surge we then experienced, which forced central banks into really aggressive rate hikes.
And the consequences of those hikes.
Slower global growth, definitely. Huge strain on government budgets because their debt costs more, and quite a bit of market volatility.
And these ripples, they go way beyond just one country's economy. You mentioned currency wars, capital flows.
Yeah, this is a key interaction. When one big player, like the Fed, hikes rates hard, and others, maybe the ECB, move slower,
Yeah.
you get big currency swings.
So like the source example, Fed hikes, ECB doesn't as much.
Yeah.
Euro weakens against the dollar.
Right, which for Europe makes their exports cheaper. Good for them, maybe, but imports get more expensive, so they end up importing inflation.
And the money flows.
That higher yield in the U.S. acts like a magnet. It pulls capital out of Europe and especially out of emerging markets, weakening their currencies even more.
Which feeds right back into that asset price realignment thing. All that cheap money inflating assets for years. Bubbles being warned about.
Exactly. And the second rates start climbing seriously, that whole dynamic shifts. Leverage gets expensive. Suddenly, a boring U.S. Treasury bond paying, say, 4% or 5% looks pretty good compared to a risky stock or maybe illiquid real estate.
So people sell the risky stuff to buy the safe stuff.
That shift in relative attractiveness is a huge driver of market corrections when rates are rising.
And it's not just markets. Governments feel this too, right? Debt sustainability, fiscal policy.
Oh, absolutely critical. Many developed countries piled up enormous amounts of debt, especially when rates were low and during crises like the pandemic.
And now the bill comes due? Kind of.
In a way, yes. As rates rise, the cost just to service that national debt, just the interest payments, jumps significantly.
Which means less money left over for, well, everything else the government does. Infrastructure, healthcare, schools.
That's the danger. It can crowd out essential public spending. And for countries already deep in debt, especially developing nations, rising rates can be the tipping point into a full-blown fiscal crisis.
Leading to painful cuts, maybe needing IMF bailouts.
Potentially, yes. That's a real risk highlighted in the source.
So these aren't just economic charts. These decisions have real, profound social and political consequences.
Absolutely. The source makes that link very clear. Historically, the economic pain from slowdowns caused by high interest rates has fueled social unrest. It's sparked protests. It's even contributed to governments falling or political alliances breaking down.
Wow.
And on the flip side, while low rates can boost growth, the source notes that long periods of cheap money have also been linked to rising inequality because they tend to benefit people who own asset stocks, property much more than those who don't.
Okay, so given this complex picture, this interconnectedness, this volatility, how does the source suggest people listening, or businesses or investors, how can they actually adapt? What are the practical steps?
Well, the main theme running through the adaptation part is really about being proactive, managing things actively, building resilience. And it starts with understanding your own exposure, especially when it comes to debt.
Managing debt. So looking at your mortgage, is it fixed or variable, that kind of thing?
Yes, but it's more than just looking. It's strategically managing that mix. If you think rates are heading up, you probably want to lock in fixed rates if you can. If you think they might fall, maybe variable makes sense, but you have to understand the risk you're taking.
And for businesses.
For businesses, it's absolutely vital to stress test their finances. What happens to our bottom line if rates go up 1%, 2%, 3%? Can we handle that?
Okay. And then hedging. That sounds complicated, like something only big corporations do.
Well, the big players do use complex tools, derivatives like interest rate swaps or options to manage their exposure. But the basic principle applies to everyone. It's about finding ways to reduce your sensitivity to unexpected rate moves.
Even for smaller businesses.
It might involve simpler financial products or even just negotiating contractual terms differently. The key is first recognizing where you're exposed and then actively looking for ways to reduce that uncertainty.
Makes sense. What about investments? Asset allocation, diversification?
That's fundamental. As we said, different rate environments favor different types of assets. Low rates were great for growth stocks, maybe tech and real estate. Rising rates can change that picture fast. Suddenly, cash isn't trash anymore. Shorter-term bonds offer decent yields with less risk. So reviewing your portfolio mix is key.
And diversification is always important, but maybe even more so now.
Absolutely. Spreading your investments across different asset classes, stocks, bonds, maybe commodities, real estate across different countries, different sectors, that helps smooth out the bumps. The source also mentions looking at alternative assets, things like private equity, infrastructure, which might behave differently and add stability.
You flagged real estate earlier as being particularly sensitive. How does the source advise adapting there?
Yeah, real estate often involves a lot of borrowing, leverage. So rate changes hit affordability hard. Higher rates mean higher mortgage payments, which usually dampens buyer demand and can lead to price drops or stagnation.
So what's the advice?
Focus on quality. Properties with strong, reliable rental income or cash flow. Locations that are economically resilient. And crucially, avoid taking on too much debt. Avoid over-leveraging yourself.
And for international property investors.
They need to think about currency risk, too, how rate changes affect exchange rates. And they really need to understand the local rate situation and market trends, not just the global picture.
Okay. What about businesses operating across borders, international operations?
They face direct hits from those currency swings driven by rate differences. So strategies there include using currency hedging tools, trying to finance operations locally in the currency they earn revenues in, and just making sure their overall business isn't too reliant on any one single country or region, geographic diversification.
And lastly, the source mentions strategic patience and liquidity. Keeping some powder dry.
Exactly. In volatile times, when rates are moving fast and markets are chalky, having access to cash is often invaluable. It gives you a safety cushion, it gives you flexibility, and it means you're ready to act if opportunities pop up, maybe investing when others are forced to sell, or just protecting your capital until things calm down.
It really is striking how these seemingly abstract central bank decisions connect right down to, well, very tangible things, like where people decide to buy a house or where companies invest, even personal choices about moving country or getting a second passport.
It's a deep connection, absolutely. And it's often missed if you only read the headlines. These rate cycles, they don't just move asset prices, they actively reshape the flow of capital around the world.
Wow.
That affects which cities, which countries attract that cross-border investment, whether it's in real estate or setting up businesses, attracting talent. It even influences high net worth individuals thinking about where to live, where to hold their assets, maybe seeking second citizenship for mobility.
So those years of super low rates weren't just boosting local housing markets. They were actively pulling international money into prime global cities. The Dubai's, London's, Singapore's, Zurich's people looking for yield or safety or just a place to park capital.
That's exactly right. And then when rates rise globally, you see the flip side. Domestic buyers in those cities face huge affordability challenges. That can lead to political backlash, calls for taxes on foreign owners, or other regulations.
So for anyone involved in international property developers, buyers just looking at the local mortgage rate isn't nearly enough. You need that bigger global picture.
You absolutely need the global context. Understanding what's driving the capital flows is crucial.
And this ties into those bigger decisions high net worth individuals make. Diversifying wealth, residency, citizenship.
Precisely. Central bank policy and the resulting rate environment is a really key piece of information feeding into those very sophisticated, long-term strategic decisions about global mobility and asset allocation. It demands a forward-looking view, much more than just comparing current interest rates.
So, looking ahead then, this isn't going away. Rate cycles are going to remain a central feature of the landscape. What does the source suggest are the key things to focus on for navigating this future?
Yeah, the core message is really about continuous adaptation and staying informed. Vigilance. First off, continuous learning. Things change fast, new data comes out, geopolitical events happen, policies shift. You just have to keep learning. It's not optional anymore.
And scenario planning, building those what-if pictures.
Definitely. Don't bet on just one outcome. The advice is to build multiple potential scenarios for rates and the economy, maybe an optimistic one, a pessimistic one, a sort of middle ground baseline, and then test your plans, your business strategy, your investments, your personal finances against each of those possibilities.
Data-driven insight feels crucial here, too.
Increasingly so. Using technology, better analytics, maybe even AI, these tools can help spot trends earlier, provide deeper insights, and allow you to react faster and more effectively than just relying on gut feeling or old methods.
And maintaining that global perspective we've talked so much about.
Absolutely non-negotiable, according to the source. No market is an island. No economy operates in a vacuum anymore. The connections are too strong. A rate change or an economic wobble anywhere can and often will have knock-on effects everywhere else. You've got to keep that wide lens.
Lastly, the source brings up trust and communication.
Yeah, an important point aimed at the policymakers themselves. Their decisions carry enormous weight. Being clear about why they're doing what they're doing, explaining the data and the rationale, that's vital for maintaining credibility, which in turn helps stabilize markets and the economy.
So let's bring this right back to you, the listener. You're sitting there thinking about your own situation, your finances, maybe your business, your plans for the future. These interest rate decisions, maybe made thousands of miles away, they aren't just academic exercises.
Not at all.
Their consequences land right in your lap. They affect the cost of your home, the health of the company you work for, the overall economic stability you rely on. It's deeply personal.
And the real challenge, I think, is to look beyond the day-to-day noise, the short-term market jitters, and try to grasp these bigger, more fundamental forces that are really shaping things, that invisible hand. You can learn to see it, anticipate its movements.
And the positive takeaway here, the source suggests that by actually making an effort to understand this stuff, by being flexible and ready to adapt, by focusing on solid strategic fundamentals, the kinds of things we've touched on today, you can put yourself or your business in a much better position, not just to survive the turbulence, but potentially even to find opportunities and thrive within it.
Yeah, I think that's right. The next chapter, whatever it holds, will likely be navigated best by those who commit to learning, who try to anticipate these shifts, and who act thoughtfully based on that understanding, regardless of what the interest rate environment actually looks like.
So maybe something to think about after this deep dive. What was the most surprising connection or consequence for you? And how might these insights change the way you approach your own financial or strategic planning?